folks. Good afternoon. It is right afternoon here in New York City. It is June 28th, 2022. Hope you guys had a wonderful weekend and a good start to the week. Let's dive right in. Let's get to business. All right. Today we saw a little bit of a pump and we're giving up those gains and more in the market today. Okay. So, again, I've been saying this and I've been saying this for months now. All right. Big picture. Okay. I think it's always important to look at the big picture. Big picture is we're in a long-term downtrend. Okay. We had a temporary rally. Okay. Temporary rally and we're giving it up. Now, does that mean we're going straight down? No. I mean, it could come here and then keep going up. That's certainly possible. The VIX is high and options positioning says that we do have lots of in-the-money puts, but a lot of it is actually for 3 to 6 months away. Actually, December looks like it's going to be a massive options expiration month. So there's a lot of far dated hedging happening right now in the markets. Okay. We're kind of in no man's land right now. Even though OI is pretty high, they are further dated. And in order for us to get to sort of more closer dated in the money puts, we would have to go down a little bit more. Okay. So definitely I think we're kind of range bound. I wouldn't be surprised if we just kind of like ping pong back and forth between certain high volume strikes. We'll see what happens. It hasn't really gone up to the point where I want to start hedging. Maybe I should have, I don't know. We'll see. Hindsight's always 20/20. So if this keeps coming down for the next few sessions, then and it just never comes up here, then yeah, I guess we should have hedged here. But I am still holding out for around 4100, 4080 and 4150, that area. I really want to start scaling into some 6-month put vertical spreads here. Okay. Again, that's the plan, and the plan really hasn't changed all that much for the past few weeks. The plan is, let me go ahead and zoom out. Okay, the plan is, again, start scaling into 6-month put vertical debit spreads here, or if it goes straight down, we start scaling in with shares at around 342 on SPY. And then also I'm going to scale into some 6 to 12 month calls if we get below that 340 zone. Okay. So my plan in the indices really hasn't changed. Okay. VIX is spiking. It looks like we have some fresh hedging demand. It looks like right here, right as we got to 3950 on the ES futures, it looks like at that point we saw fresh hedging demand come back into the market. Okay. Will it last a few sessions? We will see. Okay. Again, the plan, big picture, long-term downtrend. This is just a relief rally. We will build put debit spreads when it gets to 4080, 4150 on the S&P 500 futures, or comparatively that's like 408 to 415 on SPY. Or if it goes straight down, we start legging into shares at 342 on SPY, and then if it breaks that 340, we start legging into also 12-month calls. Okay, so that is the plan. All right. I think taking any big position right now, the risk to reward is just not there. Okay. What if we're here? What if it drops and you go long? Okay. When do you say you're going to be wrong? Are you going to hold that long position all the way to 362 on SPY? That's a huge drawdown. That's a 20-point drawdown on SPY. Okay. What if you go short and it goes up to 4080. Okay, that would be another 25-point drawdown that you're going to have to take. So if you're a swing trader, I don't think there is a good reward to risk ratio right now to enter a trade. Okay, I think it's best to just sit out and wait for those higher value zones here or here. Okay, so we wait. We're gonna be patient. Okay, speaking of patient, oil making a rebound. We're still the plan is to short oil when it gets to 119, 120. I'm going to talk about oil more today. Today, I promised everybody that I would be talking about IV Skew. We're going to use oil and Bitcoin as an example, and we'll do that after I review all of our data that we need to review. Okay, so I'll do that, for the after, let's say, about 5 or 10 more minutes of us looking at some data. Okay, so we'll come back to this. All right. What else is going on right now? Just a little bit of, let's look at the rates. We always look at the same things here. Rates, they're about break even. It started a little bit higher, gapped up today. The 10-year Treasury yield, it looks like it's coming down a little bit. Let's take a look at some of our other measures that we look at. This is the 30-year minus 10-year Treasury spread. It is coming down, so it is getting closer to flattening and being inverted. Okay, well, as at least as of today, it's getting more and more flatter. Okay. TIPTLT, inflation expectation. It started up today, but it's starting to come down. We're still in kind of no man's land. It needs to either break down or break up, I think, to give us a clear signal. And again, from yesterday, I wouldn't be surprised if it kind of does this until, it just bounces around right here until either July 13th when the CPI report comes out, or at the end of the month when we have the ECB and the Fed FOMC meeting. So we will see what happens for that. Okay, so again, I think it may go up and down like this, but we'll see. Okay, this is the MOVE index. It updated yesterday after I logged off. It is coming up, so volatility in bond markets is coming up. We're still within that range, so I don't think this is any signal yet. But I think it's important to look at least on a daily basis, especially if you're going to be active. Okay. Let's take a look at also the dollar. The dollar has been coming up. Very interesting reversal in the dollar. I mean, last few sessions we've been having down sessions in the dollar, but today it picked up. All right. Maybe it's forming a base for it to come back up again. That would be very good for our EEM puts. EEM. Oh, EEM is now down for the day. It was up, but now it's down. Okay. Some news on EEM. Actually, Sri Lanka put they put in, the government of Sri Lanka has now restricted sales of fuel for non-essential vehicles. So only vehicles that are allowed to have fuel are medical emergency vehicles, police, ambulance, trains, public buses, and everybody else, won't be getting the fuel that they need. So we're already seeing countries facing issues, already facing credit and liquidity crunches. Okay, we've been talking about this now for a few weeks. I may have been a little bit too early, but we'll see. But I think the cracks are already starting to form, and really, we're seeing countries already start capitulating. Okay, Sri Lanka, they have a food crisis, energy crisis, and a debt crisis. I think other countries will follow. Pakistan is really close to following in their footsteps. I also think that, Latin American countries, Turkey, Greece, they're going to follow soon, as well as areas that we don't really view as emerging markets anymore, like places like Hong Kong, Singapore, places like that, I think are also going to have to start tightening because of the dollar coming up. All right. So that's why, these things do take time. That is why I use the March EEM contracts. But that is kind of the gist of what's going on today. That's the big news for today. But we'll see what happens with this. With ES coming down, and the VIX going up today. And again, I can't stress this enough. I have to repeat myself on this. The plan. If you want to be a patient trader, okay, and not risk money on small moves, you're going to be patient. You're going to wait for this zone right here on SPY. That's like 408 to 415 area to build 6-month put vertical debit spreads, or we're going to wait for this to drop to 342 or so, start legging into shares for a long-term accumulation. And then if it dips below that, you can also start getting into some 12-month or maybe 6-month, or maybe 6 to 12-month calls as well. Okay, but here right now is no man's land. Again, risk management wise, if you're long and you're wrong, well, when do you cut your losses? After a 20-point drawdown? All right. If you're short and you're wrong, and it goes up, again, that's a 25-point drawdown before you know you're wrong. So, why, right now, I think it's better just to be patient as a reward to risk ratio. FXI, we're still short FXI. FXI started out way higher today. It's coming back down. Again, I'm calling BS on this move because, I'm not calling BS. I think the Australian dollar is calling BS on that move. It started higher. It's coming down. Okay. So Australian dollar is not agreeing with that kind of rally. I think it's a fake rally. We'll see. If this drops, good luck, FXI. Good luck. All right. Copper. A lot of interest in copper these days. Everybody says this is Dr. Copper. It looks at world, world output. I think this is just, a barometer for China. I don't really think it's, a barometer for the world. It maybe 30 years ago, but not anymore. But this definitely is part of my lie detector test for China. Okay. All right. So that's that. That is, the kind of markets overall in a nutshell. Let's talk about IV Skew. Okay. So I've been talking about, building spreads and how certain spreads can give you an edge in your positioning because of IV Skew. So first off, what is IV? IV is implied volatility. Okay, implied volatility. What is implied volatility? Implied volatility, it represents how much risk is present in the market. So it's the demand for price insurance. That's what options are, right? It's insurance on big price movements. If you buy a call, you are buying the right to buy the underlying asset at a certain price, at the strike price. If you buy a put, you have the right to sell a certain asset at a certain price, okay? Buying a call is a long position. Buying a put is a short position on the underlying, okay? The same thing. If you sell a call, you're obligated to sell at a certain price if the buyer of the option decides to exercise on his option, okay? So selling a call is the opposite of buying a call. So selling a call is bearish. Selling a put is bullish. Buying a put is bearish, right? So when you sell a put, you're obligated to buy from whoever bought your put. Okay, you're obligated to buy if that person exercises it. All right. So there is a skew in that. So again, so implied volatility is how much, how much of a price movement is priced in with options prices. Okay. So if implied volatility is higher, it means that there is a greater chance for a bigger price movement. Usually implied volatilities are expressed as percentages, okay? Annualized percentages. It's basically based on the options price. What is the market pricing in as the annualized move by the expiration date? Okay, and it uses one standard deviation for that calculation, meaning that let's say you buy an option, let's say a call on SPY, and its implied volatility is 23%. It means that the market is calculating an annualized 23% move by the expiration date, and that is going to fall within around 63% of all the possible outcomes. Okay, so by no means should you assume that, this is for sure, it's going to it's only going to move by this amount. No, options prices are constrained by supply and demand. Okay, so yes, as demand for that insurance or demand for that speculation increases, your IV increases. Okay, the more of a move is being priced in. All right. How is that useful? Okay, so IV has a skew to it. Okay, meaning that based on the strike, your IVs can change. All right, so let's go through an example of that. Okay, I think it's better if I just show you what that means. Here is Bitcoin. Okay, this is the Bitcoin. Won't let me full screen this part. Okay, well, whatever. Okay, so this is the IV skew of different expiration options on Bitcoin on Deribit. Okay, so as you can see here, all right, most expirations, you see that we have a little bit of what we call a smile. All right, it's a lot steeper on one side over the other. Okay, if it's steeper and high and if it's steeper on lower strikes, we call that reverse skew. All right, and if the implied volatility is steeper on strikes that are higher than at the money, then we call that a forward skew. Okay, generally risk assets like SPY or SPX, S&P 500 indices, they generally have reverse skew. Why is that? Well, because when there's a crisis in the market and when everybody is selling off and when the markets are dumping, those movements can be quite large. Okay, so the demand to hedge for some event like that has a higher demand than speculating on equities going up. Okay, so generally for risk assets, you will see that the skew tends to go for lower strikes. Okay, because again, when there's a crisis and when everybody's going to cash, they're selling. All right, so they want that protection for that downside. So that protection on the downside has more demand, therefore it has a higher implied volatility. All right, so as you can see, not all strikes or not all expirations follow the same skew. For example, it looks like in September we got some skew that is actually on the higher end. So maybe maybe in this month we have some speculators that are speculating on calls and thinking that prices will rebound. That's very much possible. In something like Bitcoin, I can see that. But as you can see, especially with the thesis that we have where institutions are hedging their Bitcoin holdings, you can see that for most expirations, the skew is toward the put side. Actually, I took, just so I can just give you a comparison, this is the S&P 500 index. These are the monthly expirations. And here is, and in Thinkorswim, they actually separate the call skew with the put skew, whereas some brokerages, they'll actually just combine the puts and calls. So what they do is wherever it's at the money and lower, they'll put the put skew in, and then for whatever is at the money and higher, they'll overlay the call skew. Okay, usually that is how a combined skew graph, that's how they'll calculate it. But again, some brokers will actually separate it for you. And as you can see, look at this put skew right here. See, it's call skews. As we get more and more out the money, the implied volatility goes up to what, 70 or 80%, and of course the skew is actually steeper the closer you are to that expiration. Further expirations are a little bit wider, okay? But as you can see here, even when it gets really high, when implied volatility gets high on certain strikes, this is for July 15th. I mean, we're looking at like SPX 6,000, 7,000. Implied volatility is at 70 or 80%. But look at on the put side, it goes up to like 300, 100, 200, 300%. Okay? So there's definitely more skew on the put side, okay? Where is it, generally, where do you see forward skew where the call side and the higher strikes have higher implied volatility? It's usually in commodities, because whenever there's an emergency in commodities, it's usually because of a shortage, right? Shortage of oil, shortage of grains, famine, a bad crop. That's the more emergency scenario. So that is why usually commercial entities will hedge with calls, because they don't want to have to buy fuel or basic raw materials to conduct their business at too high of a price. They still need to be able to operate, so they'll lock in certain prices with calls, okay? So that's why you see a more forward skew on higher strikes in commodities. But again, with indices, it's usually on the lower side, because the crisis scenario is always when prices come down and stuff like, with equity indices or with Bitcoin. Okay, so that is what I view skew is. Now, before the 80s, it was assumed that options at all strikes within a certain expiration have the same implied volatility. They did not have this concept of the skew before the 80s. And then the crash of 87 happened, and then, market makers and sellers of premium demanded that they get a higher premium payment for selling out the money puts. And that's where the whole concept of skew comes from. 1987, we had that huge crash in the stock market, and a lot of people who were selling puts went under because of that. And so to be compensated for that risk, they demanded more premium, which inflates the IV. The more you have to pay for an option, the more implied move you're calculating in that price, right? So the implied volatility goes up. And if the implied volatility goes up, that means that market is expecting a bigger move in the market, okay? So how is this even useful, okay? So, where am I getting at with this, right? So I've been telling people that right now we're in a pretty high implied volatility environment, all right? As is evident by the VIX, different, you can look at different implied volatilities at different, securities. But right now, if you look at the VIX here, I'll pull it up on the big chart right here. If you look at the VIX, we're definitely above averages. We're at a high point, 27 to 31, right? Options are very expensive, all right? So to offset some of that crush, because as time progresses, IV does come down, all right, as time progresses, all right? And so, and the skew gets narrower and narrower, all right? So if you're out the money, you probably want something to offset that IV crush. Okay, enter put debit spreads. Why do you think I've been screaming about put debit spreads this whole time? One example is the call debit. You can also do a call debit spread on something like UVXY. The reason why I use call debit spreads was because of the difference in implied volatilities. Right now, I always said that when you're building a debit vertical spread, always buy the lower implied volatility and sell the higher implied volatility. Right now, the difference is not too much between the 15 and 20 strikes in December. When I first entered this trade back in early June, this difference was way higher. I remember there was like a 10 to 15 point difference. Okay, so even though right now it's about where we started, I actually entered this spread about maybe 3 or 4 weeks ago, right as it was around in the high 13s. Okay, I'm still about 15% ahead though, even though more time has passed and implied volatility has fallen. Well, why is that? Well, it's because I had such a high IV short strike that this implied volatility, the crush on the short option, was greater than the crush that happened on the long strike. So even though the underlying hasn't moved basically for almost a month, because of the change in IV skew and because I manipulated the IV skew in my favor when I entered the trade, I am still positive. I'm positive on this trade right now still, even though I'm back to where I started. Okay, that's how you put math in your favor. Okay, same thing with FXI. I did not do the spread on August like a big dummy. All right, that was really dumb. I should have done that, but it is what it is. I kept everything very small. But anyway, same thing with here. The implied volatilities. 34 and 40. That one still has a big difference. I remember it was a little bit bigger when I first started legging in, but again, still very large. I'm long the lower implied volatility, and then I am short the higher implied volatility. All right. So if I'm wrong and if implied volatility gets crushed, hopefully the short strike gets crushed more or as much as the strike that I'm long on. And even if it's not as much, it still offsets some of that crush that I face on my long strike. Okay, it's a way to hedge for implied volatility seeping out of my options. Okay, which it will over time. Implied volatility drops. The skew gets gets tighter and tighter, and so as time progresses, more certainty is priced in, and so then you can see implied volatilities come down. Okay, so that is that is why I usually build spreads. Okay, FXI, same thing with what is it? What's another spread that I have? GLD. GLD, same thing. The reason why I picked these strikes, 18.5. I'm long on the 18.5 implied volatility strike. I'm short the 21.4. Okay, I'm long the lower implied volatility, and I'm short the higher volatility. Let's take a look at oil. All right, oil. Let's take a look. The reason why I've been saying that I'm going to build a put spread vertical debit on oil is, look at this. Look at the skew. Now, remember, I said that generally for commodities, the skew is on the call side. It doesn't have to always be that way, and market conditions change, right? If you look at on the put side, we're actually seeing some decent skew on the put side. All right, actually even more so than calls at this point. Okay, so it looks like, so that's why that, gives us a little bit of an advantage, okay, when we use spreads. All right. A couple days ago, I said that I might be using USO just because the skew is steeper. So, well, USO, sometimes it does this. Some ETFs are like this, but as you can see, it is steep as well too. And depending on which expirations, some expirations were actually steeper on the put side on USO than they were on the actual oil contracts themselves, the futures contracts themselves. USO is just an ETF that tracks crude futures. Okay, so if I were to build, let's say, a put wall now, which I'm not going to do now, I'm going to wait for 119 or above on crude oil. But if I were inclined to do this now, and if I were looking at the Octobers, you can see, you can long something that's, a 45 implied volatility, and you can short something that is at 48.5 implied volatility, putting the skew in your favor, so that, let's say it takes some time for oil to come down to your levels. While that happens, while oil is not moving or maybe moving against you, your implied volatilities are going to drop. Okay, they're going to, you're going to have some IV crush happening. And if that's the case, if there's IV crush happening, you're going to want to have something offset your long strike premium getting zapped. Okay, you're going to want something to counteract that. All right, and that is why put verticals or call verticals, vertical debit spreads are wonderful when you have that steep skew. All right. EEM, as you can see, EEM, especially for the longer dated calls and puts, these are more of the shorter dated. Again, shorter dated, it gets steeper, but some of your longer dated ones are very flat. That's why I did not do a spread on my March 2023's puts. Okay, same here. The lower strikes too here. Okay, so when we go out the money, it's not as especially for longer dated contracts, it's not as steep. Okay, so the edge is not as great, and the protection is not as great for doing a spread. So for that, because it's also longer dated, the theta was quite low. All those reasons, plus the put skew not being very steep on longer dated options, I chose not to do a spread on that one. So again, it's not right for every one of them. For every situation, you have to take a look at the skew and judge the market at the time you place that trade. Okay, so that's how you can use skew to your advantage. All right. I know for most people that this is going to be a difficult topic. I know this is probably the first time for some of you to hear this. Do you guys have any questions about this? You can go ahead and for setting up the spread. Okay, so yeah, so like I said, if I were inclined, let me just go through that example again with USO. If I were inclined to be building a put spread on oil right now, again, what I would want to do is just make sure that we have a smile toward the put side, and we do, okay? And so if I were looking at that October strike, which is that white line, you can see that we have a skew. Not as much as some of the closer dated ones, but we do have some some skew here on those October puts. Not as much. So okay, so fine. If you want to do a better example, let's look at. Well, July 8th is just a little bit too close. Let's look at another ticker symbol. Maybe we can get a better one. Let's look at IWM. Oh, perfect. This was better. Okay, so look at that skew. Okay, look at that skew. This one also has a lot of call skew too. Actually, no, put skew. Okay, so it's just the scale is different. So yeah, as you can see, there's a huge put skew. Let's look at, so let's say you wanted to do a more short-term put play on IWM, and let's say you were looking at the July OpX expiration. You know, again, what if you're wrong? What if the IV gets zapped in this? You know, you would want to protect yourself from IV getting crushed. So again, what you would be looking at, see that skew? As you get more and more out the money, those implied volatilities are going up. Okay, so let's say, you know, you wanted to be long the delta 34, you would be then buying the 170, and then you can offset that with a higher implied volatility strike, let's say 160 or so. Okay, so then you're going from, you're long the 31.8% implied volatility option, but you're short the 36.2% implied volatility option, putting some of that IV crush in your favor, so that if the IV gets crushed in your options, at least you have something that offsets it. You have something that has higher IV that is also getting crushed as well too. Okay, so that way, go ahead. Exactly. Exactly. So yeah, so you know, let's say you have a feeling that on July 15th that IWM is going to go below 170. Okay, so instead of just buying outright for 274, which is the premium right now, you can buy the 170 and then offset it by selling the 160. The 160 is right now selling for like 85 or so. Okay, so instead of paying 275 for this position, you're paying 275 minus 85. So you're paying $1.90 rather than 275 for a hedged bearish position. Okay, so that let's say it goes down to 170, let's say it goes down to 165, okay, at expiration. I mean, you still make your 5, all right, you know, you know the difference, 165 to the 170 strike, right? And then your 160s just go expire worthless. All right, and you know yeah, it caps your gains. Like let's say, like, you know, with the vertical debit, let's say it goes all the way down to 155. Yeah, you're capped. You're capped at your short strike. So your max profit is whatever your strike is, long strike minus short strike minus whatever you paid for it. Okay, that's your maximum profit. Now, if you just bought the 170s and it goes to 155, then yeah, you'd be collecting a lot more. But let's say that it takes, you know, we got 17 days left on that expiration. Let's say it doesn't move your way for the next 5 or 6 days. Are you really going to hold on to this and eat all that IV crush and all that you know, premium crush on that 170? It's a much more difficult thing to do psychologically and just portfolio wise, you know, just money wise. It's just more difficult to do. You're gonna get a bigger percentage loss if you hold. Whereas if you use a spread, at least some of those losses are gonna get offset by the short strike also deteriorating as well. Okay, so it limits your losses. All right, and I think that I think in this market, especially with all the chop, it's more important that you are able to stay in your position rather than getting chopped out. You know, if you lost out of this 270 in premium, if you lost like $1 of that, a lot of people would probably say, you know what, enough is enough, I'm out. But if you lost $1 of premium here, you probably lost like 60 to 70 cents of premium on the short strike, well, then in your whole spread, you only lost 30 or 40 cents. That's a lot more manageable. That's a lot easier to hold on to than seeing a greater loss. So again, this is just putting a little bit of math in your favor, just so that if it takes a little bit longer for whatever you believe is going to happen, if it takes a little bit longer and these options are decaying, at least you have something that's decaying in your favor. All right. That's why vertical spreads are so good when you have that volatility smile. And again, for your expiration, if it's more flat, where the difference in IVs are not so much as you get further out the money, then then you don't have to do a spread. Okay. And again, that's what I did for EEM for the March 2023 puts. I didn't use a spread because the skew was kind of flat for that expiration, and it still is. But for oil, though, I suspect by the time it comes up, right now on the put side, if you look at October, we have decent skew, but if, let's say, if we don't get our levels for the next couple of weeks, I suspect that skew is going to start steepening. Okay. And when it does, I definitely want to put the math in my favor. I definitely want to put the math in my favor and take some of that volatility crush off the table. Okay. Same thing with Bitcoin. With Bitcoin, if you're speculating on these options, definitely if you're speculating down for like a closer dated swing, like let's say you wanted to do a 2-day play on a down move, definitely, and you wanted to go long on an out the money put, definitely I would consider a vertical spread, because the skew is so steep. It's actually pretty good. You probably get be able to sell decent premium against what you buy. Okay, so that is yes, exactly. The steeper the smile is, the more edge or the more edge you get from doing that vertical spread. Okay? So the steeper it is, all right? So again, on the put side, it's very steep right here. If you were to do a swing position, definitely I would be, and let's say you thought that, I want to protect myself, or I want to profit if Bitcoin goes under 19,500, but I don't think it's going to go below 15,000 by July 15th. I mean, look at that IV curve. 19,000, you're at 79.64%, but at 15,000, you're at 97%. That is a very good skew right there to take advantage of if you wanted to do a put vertical. That's pretty good. All right. That seems to be where the steepest skew is around July 8th and July 15th. And again, from a couple of weeks ago, I said there was a lot of participation in puts and these expirations. Also the July 29th expiration as well. So these 3 expirations. So maybe the market is expecting something to happen on the downside. Maybe they're protecting themselves on the downside. So that's why there's a lot of demand for downside protection. That's why we see this skew. Okay. Now, for some reason, the skew is really good on the call side in September and December. So maybe the market thinks that it will all recover, and they're speculating on a reversal. There is an option strategy called a risk reversal, where you buy a longer dated call against selling some premium that's shorter dated. Okay, maybe that's how the market is positioned for September, December. But just from the skew, it just looks like call side has a lot of demand for September, December, but then for kind of well, except for this, this definitely is just retail speculators. Close date of 1 day, 1 DTE. Come on, that's retail. This is all retail. But as you get out here, I think these are more the institutions. The institutions are in here, and the ETH merge. Oh, really? The ETH merge. Okay, so one of our members just said that on Discord that there's an ETH merge happening here. So that's the event. Okay, so even though I didn't know the story and the happenings and whatever's going on, I can tell that the market is expecting something here just by looking at the data, okay? So that's why sometimes I just shut off all the news. I shut off CNBC. I don't open up any news articles, and I just look at the data, okay? So the data tells all right? So it's all reflected on here. So that's why looking at implied volatility skew is so important. If you're a trader and you trade options, you have to know this cold, okay? You have to know this, all right? Not knowing this is like trying to pilot an airplane with no radar and you just like blacked out your windows. So you can't even see outside, you can't even look at your radar, and you're trying to fly this airplane. That's what trading options without knowing implied volatility and without knowing skew, that's really what it's like, okay? You got to know this. And you really have to look at it when you're placing trades. So that's Bitcoin, all right? Also, too, with oil, again, just keeping with our theme, I know a lot of people are looking at oil trades right now. When we were just starting the Russia and Ukraine conflict, this was steep. I wish I had saved a picture of that. On Demand was not cooperating with me this morning and wouldn't show me this. It kept loading, but it wouldn't load fully. So that's why I wasn't able to show you that. But at the end of January, early February, whoosh, this thing was like, woof, that was crazy. It was a crazy skew, forward skew, because again, there was this fear of reduced oil and a lot of people were there was a huge demand to hedge for an oil shortage. Okay, so this was huge. So if you wanted to be long on some calls and you thought that oil was going to keep going up, it definitely made sense to do a call debit spread to take advantage of that skew, because if it had gone if the oil had gone up but not enough as was priced in by implied volatility, your call would have went down in price. Okay, so even though you were right on direction, you were not right on volatility. And if you were, so that's why it was very important that if you were going long on calls during that time period, that you use the vertical debit spread, because there were some days where the movements were just too small based on what the implied volatility had implied for that day, that week, that month, or whatever. But if you had a vertical debit spread and you managed that position correctly, you could still make money off of that. So that's why it's important that you look at these skews, especially if you're going to do something shorter dated, like 3 months or less. Okay, that's really when the skews start getting really steep on a lot of these asset classes. Let's just take a look at SPY. Yeah. So SPY also, look at that. See, look at that put skew. That put skew is high, especially what is this expiration? June 30th. Okay. So yeah, if you wanted to do a very short-term bearish play, definitely buying a put vertical makes a lot of sense. All right. Gold, same thing. On the put side, we have this skew, this steep skew Of course, it changes throughout the day as well too. So this gives you kind of a general idea, but then you always want to go through the options chain and look for yourself to see. Okay, here that was a good amount. Gold doesn't have gold options don't really have that high of an IV to begin with. UVXY is something that generally has a very high IV just because it's expected to move so much. Definitely doing a vertical spread was the right move. This is probably the most obvious benefit of a debit spread that I can show you from our current positions. Okay, literally we are right there where I first started. It was around 1380, 1390 when I built this spread. I am still, about 10-15% ahead on this spread. Am I? Yeah, I'm still 10-15% ahead. Why? Because this crushed more than this. All right. And so gave me a little bit of a mathematical edge. So even though I spent about a month holding on to this out the money spread, I'm still in the profit. Okay. These things give you an edge. The math, okay, it works. All right. I know a lot of people out there are probably rolling their eyes. Math, it doesn't work. Yeah, it does work. Okay. You put math in your favor and your probability of profit goes up. So use this math in your favor. Okay. Any questions on this? What are all the different lines, colors? Oh, you mean from the skew graph? Yeah, these are all different expirations. So the skew chart is going to look different based on different expirations. Again, generally, the longer it's dated, the more shallow the smile. It's flatter. Okay, the closer you get to expiration, the steeper that skew becomes. Okay. Lower? Okay. Oh yes, the colors. Yeah, the colors correspond to this. Oh, I'm sorry. Whenever I use Thinkorswim, I just assume everybody's looking at the same thing. I shouldn't assume that, right? Everybody's got different brokers and stuff. Yeah. So yes, on Thinkorswim, the keys on what color is what is always at the bottom of each graph. Okay. Thank you for that, MSC. I always assume people know all these things, but it's not obvious if you don't use TOS. But yeah, right here. Okay. This is the key. It shows you the different expirations. So EEM. We got some decent skew. So again, when we see this steep skew, okay. And again, for puts for March, let me just here. You know what? I can just get rid of all of that. Let's just look at March. Okay. So for March, it's not as it scales for it being 1, but if you put other strikes with it, obviously the skew is way flatter than some of the other ones. Okay. Yeah, there is still a skew. But in order to really take advantage of that skew difference, you're gonna really have to go out the money. But again, if for this it was 24. So if I had gone at the time when I did this, I guess I could have done 35 or so. I collect a little bit of a difference, but it wasn't enough to justify, in my opinion. Okay. For some, maybe, again, my position in this is very small. So I'm not going to be bummed out, just because it goes down 20, 30 cents. With the theta being this low and being far dated like this, I wasn't too worried about that. What I should have been more worried about, which I wasn't, because I was stupid, was this. I should have done this. The skew was way greater on this. Look at this, 31. It's very similar. I mean, about a week and a half has gone by since I bought these Augusts. But yeah, I could have sold like a 24, which is a 51. I mean, look at that. That's a 15 percentage point difference. I don't know why I didn't do that. That was dumb of me. That was really dumb of me. Okay? I really should have done that. That was really dumb. I should have done that. That would have, I would have had less drawdown because of that. That's where I should have done it. See, I didn't do that. And so, that's why I take the full IV loss on this. I could have, at least hedged that with gains from the short strike. But again, hindsight is 2020. I thought it was going to happen quickly. I thought, China was just going to dump. But what if it doesn't, right? You always have to think, well, what if it doesn't, right? What if you're wrong in timing and volatility? Okay, so that is your hedge. When you do the vertical and when you sell an option against it, you're hedging for the chance that your timing and your expectation on volatility is wrong. Okay, so there's that. This one, I didn't make the same mistake. Although I'm not taking advantage as much of the IV differential, but it's still pretty good, 33 to 40. Okay, so it's still a pretty good differential. So that's that. You may be asking to yourself, well, what about on uranium, your uranium play? Why don't you do a spread on that one? And again, this is what it looks like. As you can see, it's pretty flat. It's so long dated. And plus for this move, I just wanted to get like just pure lotto payout if I'm right. Okay, I didn't really care about managing risk on this one. This one, literally, I put it through my modeling algorithm that I have. I just input an implied volatility of less than 65, and with the time that it had and with all the deltas, I just calculated, well, if all of these were 65 or lower, what would the price be? And I think I started at around like 30 or so, and I put bids on all of these strikes, all the way through at implied volatility 65. Amongst professionals, I know amongst you guys, you probably, when you quote options prices, you probably use like whatever, the bid ask or the mark that's between bid and ask. Amongst professionals, especially like old floor traders and whatnot, people in the business, it's not uncommon for people to quote options prices based on delta and implied volatility. So instead of saying like, oh, the January 24th, strike 20 is 420 by 550. Instead of saying that, they'll say, the January 24th strike 20 is at implied volatility 70, or they'll say delta 55 or something like that. They'll quote it with a delta and implied volatility. That's actually quite common, or not uncommon amongst the pros. All right, so that's why. Sometimes you hear me talking about options, and I'm not saying a strike or a premium. I usually say like a delta or an implied volatility. That's why, because these two really are the biggest two variables in your pricing of your options. Okay, so for this trade, when I just entered 65 volatility, and I calculated what it would be if the implied volatility were 65 or lower. What would that options price be if it were 65 and lower? And that was my bid. Boom, 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 boom. It hit. This one hit for 2 contracts yesterday. So that's how I got in at 65 or lower. Now it's already at 66.6. So boom, there you go. Sometimes you get lucky, sometimes you get a fill. All right. So that's a low delta leap strategy for you. I'll go over that strategy more in detail. Right now, doing this strategy is like very difficult with the market being all choppy and everything. But as markets stabilize, and if I see that we're going to have a sustained rally, and if I see data of that, I will definitely go over this low delta leap strategy with you guys and what the implications are from the Black-Scholes-Merton modeling, options pricing modeling. Okay, I'll definitely go over that with you guys. I'll try to dumb it down as much as possible so that you can get the key tidbits and use that to place more speculative long-term momentum plays. Okay, that's where it really works. I think we're going to see a little bit of momentum in uranium, although we are seeing a slight pullback today. I think, metals can be very choppy. So we'll see. We'll see what happens. Very small position. I got in at a very good IV. We'll see what happens, okay? Let's just run down the portfolio real quick on our current positions. Again, I'm long uranium, all right? We are short EEM. Again, this is from our expectations of a higher continued dollar strength and the possibility that we're going to see an emerging market debt crisis happening soon, okay? So I'm still short this. I did add to my position yesterday. It looks like we're about around the same of where I added yesterday. FXI, I think this rally that they had in China, a lot of that was news driven. They had some positive industrial data. They talked about, quote unquote, talked about reopening. But I think Australian dollars and I think currency traders are calling BS on that. At first they believed it, but then it rejected, meaning they don't really believe it. Okay. And again, most currency traders work at banks. They're very, very smart individuals. Usually they position themselves way ahead of time before equity traders do. All right. So that's why I think that the move in FXI is a little BS. I think it's going to come back down. Okay. So yes, we are still long the August puts, very small positioning there. I did add some more to my put spreads. I only added onto the November put verticals. I did not add to the August. Okay. I'll just keep holding it and we'll see what happens. All right. So uranium, EEM, FXI, UVXY. I mean, we already went over this. I still have these call spreads. What else are we in? Let me just go there. Gold, GLD, gold spread. We're still long on this. Okay. That's the current positioning. So nothing has changed. Okay. Nothing has changed. The plan for my indices, I already went over in the beginning of the session. My plan for oil still hasn't changed. We see 119 or greater. Boom. I'm building put vertical spreads. Right now, USO looks kind of good. I might choose USO. I might choose the futures contract. Again, it's just whatever gives me that bigger edge in that IV skew. Whatever gives me a bigger edge on that IV skew for about 3 months out, that's the one I'm choosing, okay? An update to our plan for corn. Remember, we called the top in corn. Remember how we called the top around here-ish? We called the top. And I said if we move to 780 or so. So look at this. So what I forgot yesterday was that the contract was rolling over to the new month. The September's, hold on, is that, let me just make sure that's the active contract. No, that is not the active contract. The active contract is December. Okay. So as you can see here, all right, we had a contract roll off the front month on that on last month's which is July. The July is no longer shown on charts. Most brokerages are now showing the December chart, right? 664. Hold on, let me just make sure. 664. Sometimes TOS makes a mistake on this. I just want to make sure that is actually what is being shown here. 664. Okay, yeah, so it is. Okay, so yeah, the active month is of December. So it was July before, and there was such deep backwardation that there is a gap on the chart as the new contract took over. All the contracts that come after that July one are priced way under. Okay, the July contract had like this, I don't know, like this like $50, $60 premium to it. okay? Because the expectation was that there was going to be this corn shortage. Well, it doesn't look like that's going to happen. And so now it just dropped. You know, sometimes the grains do this, you know, when as it rolls over into the next month, it's got this huge gaps in between. So now I'm looking at the active month. So instead of, I said if we get to 770 or 780, that's when I'm going to build those put spreads. Looking at it now, we're gonna have to go a little bit lower than that. Well, I'm looking at more like 725 to 730. Okay, so that's an update to the plan, the corn short. Okay, so again, the plan, we're gonna short corn at 730, 725 to 730. That's where I'm going to build some put spreads. I'll do that directly on the corn futures contract. Okay, options on the futures contract itself. All right. So that's the plan. That's the updated plan. So we got our positions. I'm still about 95% cash. So nothing, you know, too big. I'm legging in very slowly to our EEM puts, our FXI puts. I'm still waiting to do our big trade, which is to put debit vertical spreads when the S&P 500 gets to 4,080 or 4,150. Okay? So that plan hasn't changed. Any questions? Any questions about skew, options, anything else you guys want to go over? Any charts you guys want to go over? Going once, going twice. Oh, actually, you know what? Before we leave, let's take a look at options for Bitcoin. I know everybody's talking about Bitcoin. Everybody wants to trade Bitcoins right now. Let me go ahead and show you the options positioning on Deribit for Bitcoin. Oh, Nunya wants to do an ER play. Typical Nunya trying to gamble. In the position volume, I want Vega, Gamma. I don't want. Yeah, that should be good. Okay. All right. So usually the closer dated stuff doesn't really have that much volume. We got decent volume here for the weeklies. It looks like we got some heavy OI close dated for 20,000, 19,000, and 15,000. Also here 18. So these are the pivots that I would look for. Okay. Generally, when you see prices approach and then your volatility right here is coming down and you start seeing puts getting sold off, usually you see a rebound. Okay. And again, from dynamic options hedging, when the market is selling puts, the market maker is buying those puts. Buying a put is a short position. So to even out their books, they have to go long on the underlying, okay? So that's why, you know, I always look at the options data rather than, you know, to some crayon lines on a chart. When you see these levels get approached, you see the implied volatility and the volatility of the options coming down and puts are getting sold. That is, you know, that's a good indication that we're going to see the market maker is going to cover its short positions. Okay. So those are the pivots you want to see. Now, same thing though, if you see that we're approaching a big OI or a big volume strike, but then volatility is increasing and you're seeing more put buying, that could mean that we're actually going to fall faster. Okay. Because all the people that are now short put, the market maker who is short puts at this level, who is now obligated to buy at 20,000, they're going to want to cover their puts. So either they're going to buy back those puts, which means another market maker is going to have to buy those puts, even out their books and short, or market makers are going to have to hedge and start buying puts at other strikes, at other expirations to manage that delta and gamma exposure. Okay, so that's why those are pivots. It doesn't necessarily mean we always bounce from those levels, but some type of big market action happens at those big OI, big volume strikes. Okay, and that is from dynamic hedging. And our thesis is that dynamic options hedging is in the Bitcoin market, just like, just like in the indices, like in SPY, a lot of day-to-day price action is controlled by the options market. I think that in Bitcoin, we're seeing the same thing. Actually, we got confirmation from, I think the news media wrote something about this. I shared it on a Discord about about a couple days ago. They wrote about this. We were looking at this though from a month or two ago. So we're ahead of the curve here. Okay. So because we're always looking at the data. We're not waiting for somebody to publish something about it. We always look at the data first, okay? Data speaks very loudly. I think a lot of institutional dynamic hedging is happening in the options market for Bitcoin. It controls a lot of price action that we see throughout the day. But at least in the short term, that's what I see. These are your high OI strikes. And again, just from what I said, it doesn't mean that we always bounce from there. It usually is, we have to approach it. Volatility has to drop and puts have to get sold. All right. And when that's the case, then it bounces. All right. Or it could be even worse. Like, all those market makers that are short those 20,000 puts, they don't want to take assignment and they don't want to take further gamma loss, so they're going to have to hedge their gamma and delta exposure and buy more puts elsewhere. Okay. And that will cause prices to capitulate even faster downward. So it really just, it's not just about the OI and the volume, but it's also how is volatility trending as this happens and what's the order flow in the options. You need all of that to confirm. Okay. Let's take a look further out. Not as much, but high OI, but just not as much volume today. So there was more, so, it's concentrated in this July 1st, July 8th, we got OI, but not as much volume today. Not as much volume today on July 15th. Let's look at the monthlies. Oh, we're seeing some more volume here. Funny how we're seeing more volume on a little bit more down. So there seems to be a demand to hedge at 15,000 here. Okay. There seems to be a lot of demand to hedge at 15,000 today. All right. There's some high OIs here too. Actually, we got some high OIs that are in the money now. That's going to be very interesting. If volume just drops, whatever risk event that the market is hedging for, let's say volatility drops and all these in the money puts start selling off. Oof, that could be a huge short squeeze. Okay, that could be a huge short squeeze. Same thing actually on here. I noticed that there was actually a lot of call selling as well too. There was a lot of call selling over 24,000. I saw huge block trades for calls being sold. I think before July 29th, if we close over 25,000 for maybe a couple of sessions, I can see there being huge covering on the call sides where people have to buy their calls back, and that could send the market up too. It's a possibility. I'm not trying to predict the future. I'm just saying if. There's all these ifs that have to happen. But if it does, I could definitely see a potential for a short squeeze. Okay? Let's look at the quarterlies, because there's some action in the quarterlies actually. So, and institutions tend to be more further dated. Retail likes short dated. Okay? Institutions usually hedge for 3, 6, 9 months down the road. All right, as you can see, your daily volumes may not be as high, but they are accumulating. Look at these OIs, huge OIs, 20,000, 18,000, 15,000. Again, these are the strikes that commonly come up throughout all of most of these expirations. All right. I remember on the Septembers and Decembers, there was a lot of calls being sold around the 35, 40,000 area. from last week or the week before. So if we have a short squeeze in July and it gets over 24,000 and it shoots above 36, 38,000, potentially it could be even more. Like if it goes over 24 and then closes over 35, 36,000, well, actually a little bit higher. I believe I saw something. I saw more of 40,000. But yeah, but if it starts challenging these areas before September, even more short squeeze, because I think these are all short calls. There's been a lot of call selling, big block call selling. Okay, basically it's a collar. Okay, people do this with S&P 500 all the time. They sell calls and they buy protective puts with it. Okay, I think that's what the market, all these institutions did. They sold calls and they bought protective puts. Okay, to hedge for lower prices. But if prices just shoot up, then yeah, I can see short covering happening in calls. So if the market is buying calls, the market maker is having to sell calls, which is a bearish position for the market maker. They will have to buy the underlying to neutralize their delta. Okay, that's where short squeezes happen. Short squeezes can happen like that. Either short calls are, they're buying it back, because it's busting through those strikes. Or we see people cash their put hedges, and so the market maker has to buy the underlying because they're buying all these puts. Okay, so that's usually how a short squeeze happens. Let's look at the Decembers. Decembers, I think, are huge, right? Yeah, remember like those OIs I showed you in December a couple of weeks ago? We saw those huge OIs for December SPX for S&P 500. And look at that. And remember how I said it was a monster options expiration? Look at this. This is a monster options expiration for Bitcoin. It's December. So everybody's hedging for the end of the year. Again, it just kind of goes with my thesis that I think this is a lot of institutional hedging. It's institutional behavior. It's such institutional behavior, and it matches SPX. How likely is it that it's just a coincidence? I don't think it's a coincidence. I don't think so. I don't think it's a coincidence. Of course, I would like to, wait a little bit more and see, but I don't think it's a coincidence at all. Again, we're seeing a lot of demand, 20,000, 15,000. So anywhere between 20 and 15,000, we are seeing just a lot of demand for hedging. Okay, huge OIs are in there all the way out to December. Okay, so we'll see. Calls. I think based on Skew. In the September and December, I think some of these might be actually longs. Some of these might be longs. We shall see. The metrics page, yes, the metrics. I was actually going to pull that up too. Let's see here. I have it bookmarked. This is the current day. See, calls sold, calls bought. Last week, this was different. This was way different. Calls sold with block trades was like, it was way bigger. Like this was the majority of the circle. The calls sold last week. I wish they let you see like the previous dates, but they don't. It only shows you the current day. Oh yeah, I know. You can start technically downloading it daily. I know that, but I think there's also an API that I could use at a different place. I think I'm gonna start downloading that too. So we'll see. Either that or I guess we do this. I mean, I do that with junk bonds anyway, so I might as well do it with this. Maybe you're right. Maybe I just start doing that with this. Okay, so yeah. But anyway, from last week though and week before, this was just a bigger part of the circle. Today, not so much. I think what's more telling, I mean, this is like day-to-day stuff, and which is just great. I mean, there's nothing wrong using this, but I think a lot of I think you could tell a lot just from this. Hold on. Back to our original topic here. I think this tells us a lot. This tells us a lot. The skew, okay? More bullish positioning further out, more hedging demand for sooner, for closer dated. This tells us a lot about current positioning and what the market is, what the market sentiment is. It really tells us a lot when you look at this like this. Okay? Where's the demand? Where's the order? Where's all the demand at? Okay? The demand for closer dated is all in the put side. But then as we get further out, it's becoming more like call side. Okay? Especially for September, December. So maybe something happens here. Like, you know, somebody mentioned that it was the ETH update. Maybe afterwards they're expecting the markets to go up, or maybe also too risk sentiment. Also, it happens to be that after September we have all the major Fed meetings are over. Yeah. Okay. Yeah. So yeah, somebody just said that there's rumors that the Fed will pivot. You know, I'll say this. You know, speculating on what a central bank does and putting money on it is a fool's game. I've said this many times. But you know, as far as, you know, just anticipating what could be, we're already seeing signs of that. Remember last week we said that over the Juneteenth weekend, the Fed already was signaling that they might take their foot off the pedal when it comes to tightening. You know, we've been saying this now for about a week now, that is definitely a possibility. Bullard gets on TV now and he talks about how all this tightening may not be necessary. And it's just like the 70s. History doesn't always repeat itself, but it often does rhyme, okay? And the same thing happened in the 70s. We had inflation in the early 70s. It wasn't until Volcker in 79 that somebody was serious enough to really stomp this inflation out and keep tightening, even though inflation wasn't accelerating as fast. Okay, that's the problem, is that we go from this like inflation fear to this recession obsession. Okay, there's no such thing as a soft landing. I mean, there's going to be, you know, in order to really effectively stomp out inflation, there has to be enough tightening, and that tightening is going to cause a recession. Okay, I don't think there's any way out of it. I think that if they delay this more and more, we're going to have a situation where we're going to have to raise rates way higher than what we need to if we were to just stomp it out now. And not only that, we're also going to have to look at fiscal measures too, not just monetary policy. We're going to have to look at raising taxes. Okay, and I've been saying this since like December, that 2024, I expect the U.S. government to have to raise taxes. Okay, I've been saying that since December. So we're definitely on that trajectory. If central banks start loosening or they stop tightening just because they notice like 1 or 2 months where inflation is not going up as fast, I think that is going to just extend this whole thing. Now, could we see a mini bull market in between? I think so. You know, and just like in the 70s, we had mini bull markets that lasted a year or so, all within this bigger downtrend, a multi-year downtrend. Definitely possible. Okay, it's all within the realm of possibilities. Okay, and so as traders, what do we have to do? What do I always say? We manage risk and we protect our capital. Number 1, number 2, number 3, number 4, number 5 things we think about. Okay, the top 5 things we think about: risk management, risk management, risk management. Okay, we have to protect our capital. We have to manage risk. We have to anticipate 5 or 6 moves ahead. Okay, that is the most important message in all of this. And use IV skew, use data, use math to your advantage. Okay. It's hard enough as it is when you use all this data to your advantage. And if you're not even going to use it, think of how behind you're going to be with everybody else. All your competitors, all your fellow traders, institutions that are competing against you, they know this and more. Okay? So if you don't know the basics, what kind of competition do you think you're really going to be? All right? You're like flying an airplane blind. All right? So use this. Ask me questions, you know. Message me. Hey, Mickey, go over that IV skew again. I can go over this over and over and over again if you guys want. Okay, I think it's that important. It's important enough where we can redo this kind of type of session over and over again and look at examples of this and different securities and different trades that we do throughout the year. Okay, so this is a very important topic. That's why I spent a lot of time on this today, because I think this is super important. This is probably one of the most important things that I'll show you, is how to use IV skew to your advantage. Okay, so ask me questions. All right, Nunya wanted to see MU. So as we go, let's just take a look at MU. Oh, earnings on the 30th. Oof. I mean, what do you want to do with this? Are you going to buy calls or buy puts? Are you going to gamble on this? I'm not the type to gamble on something like this. Yeah. Yeah. Okay. Well, that's crazy. Okay, if you're going to take a directional bet, look at this IV. Look at these IVs. Yeah? Okay, which strike are you in, Nunya? Which one? 85 for MU? 85 puts. That's way in the money? You mean 55, right? 58. Oh, 58? Okay. Okay. So it's unchanged from yesterday. Yeah, I mean, if it were me, I would have done a spread. I would have done 58, 48. No, not 48. Well, yeah. I mean, the IV is still very high, no matter how you go. I mean, you'd have to go out to get a meaningful IV. I mean, but still, because of the decay that you're gonna face, I would have still done the spread, even though the skew may not work really that much in your favor, but the decay that it could potentially face after the announcement, that's why I would have done a spread here still. This is a little. Are you cutting before the ER? Okay. Well, so you're just playing you're just doing the IV pump. You're just playing for the IV pump. Okay. That's okay. Interesting play. Interesting play, Nanya. But yeah, it's a very short term. Yeah. Yeah. I mean, yeah, if you bought calls, I mean, you just got eviscerated. If you bought puts, you had to buy really in the money. If you went even just slightly at the money, you're still at a loss. Because again, yeah, IV was just so high. The implied move implied by the price of options was so high, which means the price of that option was so jacked up that if the move doesn't justify, if the realized move doesn't happen, if the real move that happens is less than what's priced in, your options are going to drop in price, even though you're right on direction. In options, you got to be right on three things: direction, volatility, and timing. Okay, you have to be right on all three. Okay, to really maximize your profits. And a binary event like earnings release, you really have to be right on the volatility, on the amount of that move as well. Okay, and that kills. Usually that's why people who do ER gambling, they usually lose. Um, yeah. Yeah, so right. No. No, there was no. I don't think there was. Yeah. So again, usually for that, it's usually the people that win in this are premium sellers. So those premium sellers made very good money. Okay. Good for them. Okay. Well, that's what happens when you gamble. That's why that's why again, I always keep saying this. The big money is always in the multi-week monthly moves. That's where the big money is. This, I mean, it's so risky. You can't even do that big of a position. So even if you win, you don't really win all that much. Like this is not something you can lean on. And again, why waste your time with something like this for peanuts? I think the big moves where you can lean on that with a high probability chance of you hitting, that is the type of trade you got to focus on. These are fun. Yeah, I mean, I get it. And I know some people's temperament. Some people like to do it for fun, but that's just. I think if you especially if you got a smaller account and you're trying to build it up, you really have to focus on your high probability trades and your multi-week monthly moves. That's how you stay in the game, and that's how you can really generate high rates of return. You're not always trying to dig yourself out of a hole, okay? Because inevitably, if you do these high risk trades, you're gonna have drawdowns. All right. The point is to have big, good moves without drawdowns. And in order for that, you got to look at the big trends, okay? The big trends, and you have to plan way in advance, all right? I think, it's just like, when you guys, when I told you guys about the put walls that I was building right here and late March, early April, that was a big move, right? Big move, high quality move, something that I could lean into, all right? That's what you want to save up for, especially if you have a smaller account. All right. But anyway, somebody wanted to see ENDP. What is this? What is ENDP? Endo International? What is this? Oh, it makes Plan B. Oh. Okay, well, for those of you who are not Americans, we just recently went through a Supreme Court case where they reversed Roe versus Wade that stops the federal government from prohibiting states from outlawing abortions. Okay, and so I guess it's caused a pop in some of these birth control and birth control companies. I know somebody else was talking about some other stock that was like this. Okay. Oh yeah, I mean that's not look at this, look at the put the call ratio at 0.06. Look at that. 14,000 calls above ask that are bought, and look at the puts. Puts combined, there's like less than 2,000. That's funny. 14,000 just on the calls. Wow. What are they buying? What are people buying on this? July 15, $1. That seems to be, yeah. That's where all the strikes are. So July 15, $1. Oh, wow. They bought it for 5 cents? $350. I mean, that's where it is right now. So they bought it. They're up. I mean, yesterday it was 5 cents. Right now it's 10, 15. So they either doubled or tripled based on where they get filled at the bid or ask. Okay. I mean, that's very exotic. That's a very exotic play. Current IV percent. Oh, look at the IV percentile, 76%. I mean, you would be a fool to buy options right now. I mean, it'd have to be really super small, like super small lotto. Like you would have to expect this to go to zero. All right. I mean, yeah, I only updates. Yeah, at 2 a.m. Chicago time. Jesus, that's just, I don't know, man. Oh, look at this. July. Oh, now it's at 1520. Oh, it's still going up. Oh, it's going up. Oh, look at that. All right, well, good for your friend. All right, congrats to your friend. Oh, wow, October's. Man, they should have bought something high, a little bit longer dated. This October was 7 cents, 10 cents. Maybe they could have gotten it at 10. Yeah, anyway, yeah, I mean, it's very exotic, very high risk. I don't know, if this is what you find fun, I guess you could do that. I find this very stressful. Yeah, I just find this very stressful. Yeah, just looking at this makes me stressed out. There's going to be a lot of tears by the end of all this. There's going to be a lot of tears. A lot of retail tears. Yeah, I can already see it. Yeah, that's just oof. Okay, so again, let's just take a look at some of our positions. Dollar up, Australian dollar still calling BS. Oh, look at that, FXI. Oh, losing its over 2% gain from this morning. Look at that, data wins. All these crayon lines on the chart. I mean, it's great. It's decent, I guess. It's really all about the data. Come on, I mean, let's be real. It's really all about the data. All right. Let's just look at copper. What's going on with copper? Copper, oh, losing all its gains for the morning too. Hooray, hooray. Okay. All right. Oh, come on, baby. All right, that would be a nice end of summer gift if all these pay out big. I mean, they're not big positions. I didn't want to put too much risk. I'm saving my funds, my spec account, for those big indices levels. Again, the big trades that I'm gonna lean on is I'm waiting for 4,080 to 4,150 on the S&P 500. I'm going to build 6-month put debit spreads, or I'm waiting for 3,420 to load up on shares for the long term. After it dips below 340, I'm going to start buying 12-month in the money calls. I'm going to short oil via long put debit spreads on oil futures contracts, options, or I'm going to use USO. I'm going to do that when it gets over 119. I'm also going to short corn via long put debit put spreads on the corn futures contract once it gets over 725, 730 zone. Okay, so that is my plan going forward, and those are the big high probability trades I'm waiting for. Okay, I'm 95% cash. I'm waiting for those big trades. Okay, those are the big quality trades I'm looking for. Okay, indices, either long or short based on our levels, like I just said. Shorting corn, shorting oil, but I want those higher levels. Why do I want those higher levels? Even though the data supports everything that I say, corn, again, from yesterday's video. Mickey, you say that, corn plants are going to get revised up. Oh, that's a stupid chart. So, Mickey, but you said this, the planting season, why don't you just go ahead and short now? What if you miss out on the opportunity? Yeah, there's a chance. If it just keeps going down, I miss out. So what? So be it. But there's no effective way of managing risk if I enter short here, because what if it retraces up? Am I going to hold on for a 50, 60 point move up? I mean, technically this could go up. It's still form a downtrend, even if it goes up to like, I don't know, even if it goes to 720, that would mean it can go up 10% and still form a downtrend. Okay, am I gonna wait 10% to be proven wrong? That's crazy. That's nonsense. Okay, risk to reward says we wait for here. Why? Because if we're wrong, because no matter how good your data is, and I keep telling everybody is data wins in the end, but it's not 100%. So even if you're right 95% of the time, that 5% can wipe you out. Okay, so you know we again, number one job, number two job, number three job as a trader, protecting your capital, risk management always. Okay, that's why I'm going to enter short here, because if I'm wrong, all I have to do is face a very small drawdown, maybe 20, 25 points, which turns out to be about 3 or 4%. That way more manageable than getting facing 8% against you. Okay, I would rather get out with a smaller loss than a big loss. All right, so that's why high quality right here, because if I'm wrong, boom, and then I'm out. You know, all it takes is just a very little bit. I know very soon if I'm right or wrong. Okay, it helps with risk management. Again, it's all about risk management. What if I'm wrong? Okay, oil, we call the oil peak right here. Oh, Mickey, but why don't we just short here? Come on, what if we miss out? What if we miss out? Yeah, well, we could. Okay, but again, what if we're wrong? What if it retraces all the way back to all-time highs again, or the local highs right here? I would rather short above this 119, 120 zone right here. So if we're wrong, we only have to face like a 3% again. It will only, the oil will only rise like 3 or 4% against us if we enter the short here. High quality. Okay, I want to lean into this, and I want to make sure that if I'm wrong, my losses are small. All right, risk management. Okay, but I think if it comes up to here, oh my God, what a gift. Oh my goodness. I'm just ready. I got the alerts set up and everything. I'm ready for this one. Okay. That's my plan. All right. Anything else you guys want to see? Today was a longer video. Today was an hour and 40 minutes. Again, it's because we went over a lot of option stuff. We went over crypto. We went over all the data. We went over options, IV skew. Today was a pretty dense video, but I do recommend that you guys go over it, ask me questions, write down, take some notes, write down any questions you guys have, and we can always go over this concept again. I think this concept of IV skew is important enough for me to repeat over and over again. So if you guys need me to repeat it over and over again, by all means ask, okay? Because I think it's a very important concept. If you're going to trade options, you got to know IV and IV skew. Also, too, even if you don't trade options, just with Bitcoin and S&P 500, just because again, options are taking over the Bitcoin market. So even if you're just trading Bitcoin or just trading cryptos, I still think knowing how options work will help you trade your cryptocurrencies as well. Okay, because a lot of that price movement is based on options positioning and that dynamic options hedging that institutions do. So even if you aren't directly going to buy and sell options, you should understand it so that you know why certain movements are happening in the cryptocurrency world. Okay? Thumbs up, thumbs down. Questions, comments, rude remarks. Okay. All right. Very good. All right, guys. Well, in that case, I'm going to sign out as far as live streaming is concerned. I'll still hang around the Discord chat group. I'll still keep charts and the data streaming on Twitch. The video I'll put up on wiretap tapes, via YouTube. And we'll do this again tomorrow, same time, high noon highlights, noon. Eastern time, every Tuesday, Wednesday, Thursday. And if we have an emergency session or if I see any developments where I think another video is worthy, I'll make another announcement. Okay, guys? Trade safe. And let me know what else you guys want to see on the videos, okay?